Hello folks, this is Tony Drake from Drake & Associates with an educational economic update for February 2019. In this month's video, I'll discuss some of the major headlines that influence markets in the month of January. I'll also provide some insight into what these developments could mean for you as an investor. Now, as always, please stay tuned at the end of this video for a required disclosure statement. January 2019 is behind us, and what a difference a month makes. By the end of 2018, the S&P 500, Dow, and the NASDAQ posted their largest annual declines in years. In fact, the S&P 500 and the Dow experienced their worst December results since 1931. Now you fast forward a month, and momentum has swung in the opposite direction. The S&P 500 added 7.9%, and the Dow was up 7.2%. These gains mean both indices had their best January performances in at least 30 years. The NASDAQ also increased by 9.2% last month, which was its best January since 2001. These gains occurred despite the longest government shutdown in history continuing for much of the month. So the question begs itself, why did the markets rebound in January? Well, a few details helped change investor sentiment, including Federal Reserve comments and corporate earnings season. In December, there were concerns about how quickly the Fed was going to raise interest rates, and that contributed to market declines. By January, however, Fed officials indicated several times that the central bank would begin taking a more dovish view. Now, the Fed also chose not to raise rates after its most recent session, saying it will be patient when deciding on future increases. Market confidence definitely grew from that information, knowing that the Fed is not rushing into rate hikes anytime soon. Corporate earnings season also largely affected stock performance. By the end of the month in January, about half of the S&P 500 had released their fourth quarter results. The data reinforced that corporate growth had slowed later in 2018, offering no new surprises. Instead of driving market losses, however, January's earnings releases contributed to market growth. Now, why, you might ask? Well, that's happened in part because a few solid reports from large companies helped ease investors' worries about a potential recession. In February, we'll see the remainder of corporate earnings season that lies ahead. Now, both global growth and the ongoing trade discussions between the U.S. and China may also remain on investors' minds. Further, it's important to note we should receive some delayed data, which was postponed by the government shutdown. Now, this data will include the first reading of fourth quarter gross domestic product, or GDP. In the weeks to come, we'll be monitoring these and other details, and I'll look forward to sharing new perspectives with you as this data arises. Now, that's it for this month's educational economic update. Please visit us at wealthwisconsin.com to learn more about our upcoming educational workshops, and be sure to listen to the Retirement Ready radio show on AM 620 WTMJ Saturdays at 1 p.m. or the on-demand podcast through your electronic device. Once again, this is Tony Drake from Drake & Associates signing off for the month of February 2019. Now, as always, please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call. We'd be happy to talk. Thank you.